My name is Marvin Weiss, and in today's video, we are going to talk about how to make $1,000 per day as a trader. So let's get comfortable because this video can absolutely change your life. It's going to be beautiful. So $1,000 per day. That's what we're going to talk about today. In pure profit, obviously, as a trader. Now, in case you don't know me, my name is Marvin Weiss. I am an entrepreneur who turned day trader, okay? I used to have what other people nowadays call a social media marketing agency, and we were doing great. We had really amazing months, and one of my clients back in the day was a so-called prop trading firm, okay? Now, in case you guys don't know what a prop trading firm is, it's basically a company that gives their capital to traders to trade with, and if these traders make a profit, this prop trading firm gets 20% of the profits, and the traders usually get 80% of the profits. So the more the traders win, the more the prop trading firm makes as well. The traders don't have any risk to trade with, and the prop trading firm can allocate their capital to as many traders as they want. And while I was working with this company, I saw guys, regular dudes, okay? And they were making, it was insane back in the day, and they still are, over $100,000 in pure profit every single month. While I was working my ass off in my social media marketing agency, they were doing these numbers, working 20 days a month, so from Monday through Friday, because that's when you can trade, about 1 to 2 hours every single day. So I got hooked. I was like, I'm gonna need to figure this out. So I became a profitable trader myself. And in this video, I want to share with you 3 secrets, 3 things that you need to know in order to go from 0 to $1,000 per day in pure profit. Okay, we're not going to talk revenue because there's no revenue in trading. There's only losses and wins, gains and losses, profit and losses, no revenue, none of these BS numbers, just straight cold numbers. Okay, so what is $1,000 per day? If we break it down, $1,000 per day in and of itself is a result, right? A result. And what is responsible for this result? Basically, what's responsible for any result? Let's take a look. If you are someone who doesn't go to the gym, no gym, and you eat junk food, and my handwriting is absolutely awful, but I hope you guys can read everything, and you're also lazy, what is going to happen? You are going to be fat. If you're spending too much money and you have a low income, what is going to happen, guys? I can tell you now, you are going to be broke. So the inputs, bad inputs, they lead to a bad output, right? So in this case, you're either broke or you are overweight. In trading, there's also certain inputs that lead to a certain output. So for example, if you trade the wrong market and you trade with too little capital and you trade with a strategy that is not working, then you will become unprofitable. However, if you do things correctly, so you trade the right market, you trade with enough capital, and you trade with a strategy that is working, then you will become profitable. Okay? So your focus in and of itself in anything in life, every time you have a certain goal, a result that you would like to achieve, don't focus on this. Don't. Focus on the inputs, because these inputs will lead to an outcome that you would like to achieve. Okay? So if you want to lose weight, well, go to the gym, don't eat any more junk food, and don't be lazy. Get out and do something with your life. You will not become fat. You can't. It's almost impossible. Okay? And instead of seeing this huge humongous goal of, oh, I need to get to 1K per day, which is absolutely, it's a big goal for most people. It can be overwhelming. Well, let's just break it down into 3 simple steps. Let's focus on which market are we trading, how much capital are we trading with, and what strategy are we using. So let's actually get started and talk about the market that you're going to trade with. A market is basically, and simply put, just the instrument that you're going to be trading with. All right. So as a trader, and you guys probably know, not all of you guys know this, you can trade Forex, right? You can trade stocks. You can trade options. You can trade futures. The list is endless nowadays. You can trade crypto, obviously, all of that good stuff. However, the market that you trade is fundamental, because if you trade the wrong market, it doesn't matter how much capital you have, and it doesn't matter how magical your strategy seems to look like, you will not make money. The market that you trade, the instrument that you trade, is the foundation to your trading success. Okay? Now, most beginners, when they start, what do they trade? They trade with Forex. Look at all the prop trading firms out there, FTMO and all of these companies. They make millions of dollars because everyone is trying to become a profitable Forex trader, even though it is the absolute worst instrument, the worst market that you can trade if you are a beginner. And here's why. So there's one key concept that you need to understand, and that is the concept of an exchange. What is an exchange? Well, think about the Apple stock, for example. You have a chart, okay, perfect. And you see the Apple stock is trading back and forth, back and forth, back and forth. At some point, or at some days, it's at $120. Here it's at $140, and here it's at $100. And basically, every single trader around the world sees the same price, because the stock market has a centralized exchange. That is key. Now, when it comes to the Forex market, things look a little bit different. If you are trading with your broker, and let's call them broker one, you might see that, for example, Euro USD, okay, that's the pair that you trade with. You might see a chart that looks something like this, right? And this is going to be very important now, because what do you have down here? Well, that is what most retail traders call support, right? And you see this chart right here. However, your friend who sits right next to you, and he's trading with broker 2. He's also trading the Euro USD pair. He sees something slightly different. He sees this. So where there was support with your broker, well, we also had support here. However, we went below this support line down here. We fished all of these stops that are here, which we'll get into in just a moment. And then the market went into the same direction. So I'm not telling you that the Euro USD pair can look extremely different from one broker to the next. However, because these brokers, the Forex market, it doesn't have a centralized exchange. That is why you sometimes see different things to all of your friends, even though you're trading the same pair. So what you need to know is, if you are trading an instrument with an uncentralized exchange, meaning there is no centralized exchange basically, every broker can kind of do whatever they want, you are doomed to fail. Look at the failure rates of traders trading Forex. It's insane. Trading Forex is extremely difficult, and that is why I only trade the futures. I trade the Nasdaq, I trade the S&P 500, I trade oil, and I trade gold, because all of these 4 things have one thing in common. They have a centralized exchange. The price of oil is the same across every single broker that I trade with. So I cannot have this situation where I believe this will be support, and then boop, I get fished and I'm in for a losing trade. That is the first key concept. So stop trading Forex. Start trading futures, stocks, or options. All right. Now, next point. that I want to talk to you about is the capital. Okay, so how much money are you trading with? Because if you trade the right market, however, you trade with not enough money, your capital is just not enough, you are doomed to fail as well for a very simple reason. Let's say you're actually quite a good trader and you make 5% per month. Okay, that is your performance, 5% per month. And let's say you trade either A, with your own money, or B, with a prop trading firm's money. Okay, let's say you have your own money and you have $5,000 saved up that you would like to trade with now. Well, if you now make 5% every single month, you make a whopping $250 per month in profit. I'm not sure about you, but not really exciting, right? Or if you have 10 grand saved up, then you make a whopping $500 in profit every single month. Guys, I don't know about you, but that doesn't get you rich. That doesn't let you quit your job and become a full-time trader or even get close to making $1,000 per day. It doesn't even get close. So that is why I want you to stop trading with your own money and start using prop trading firms. Like I mentioned before, prop trading firms are companies. They give you their capital to trade with for an exchange of the profits. So you usually keep 80% of the profits and they usually get 20% of the profits. It's a very complex topic. However, that is the basic gist of it. You don't have any financial risk trading. They cover that risk. And you basically want to make a profit, get a payout of whatever you make, about 80% of it. Okay, now the cool thing is you can actually go ahead and purchase a trading account. You first have to go through a challenge. And once you pass that challenge, meaning you actually showed them, you proved to them, hey, I am a profitable trader. And this challenge usually costs depends on where you purchase it, like $40. You then can actually get funded with for example, $50,000 trading account. You would have to actually purchase an activation fee, which is usually about $100 plus, just so you guys know. So for $140 roughly, you can get access to a $50,000 trading account. Now, the cool thing is, if you still do the same percentage, the same performance, 5% every single month, you now make $2,500 every single month in profit. Now, guys, you're still not rich with $2,500 in extra money every single month. However, this is enough money to take a nice vacation, go shopping, go to a nice fancy dinner with your wife, with your girlfriend. It doesn't really matter. Treat your loved ones, invite your friends. That is enough money. That's a good start. And the cool thing is, these prop trading firms allow you to trade with multiple accounts. So what you can do is you can place a trade in this $50,000 account, right? And you can copy it. And that's the cool thing now. You can copy it across 1, 2, 5, 10, even 20 accounts. So you make one trade in this account and it gets copied into all of these accounts that you also have. And the cool thing is, if you have 5 accounts, well guys, then that $2,500 now becomes $12,500. Or if you have 10 accounts, and you can do the math already, we are already at $25,000. Or if you have 20 of these trading accounts, guys, you're already at $50,000 every single month. That right here is generational wealth. Generational wealth. And this concept here basically is called OPM. In other words, other people's money. And maybe you've heard of a guy called Warren Buffett, right? Well, Warren Buffett with his company, Berkshire Hathaway, they don't do anything else. They're on the stock market. Their company is listed on the stock market, meaning they are collecting money and cash from other people in order to invest in companies and make a certain return. And Warren Buffett gets a cut of that overall profit. other people's money, guys. That is how you make large money in trading, okay? Now, last but not least, we've already talked about the market that you're now trading. We talked about the capital and why you should trade prop trading firms. And now I want to go ahead and actually give you a broad overview into a strategy without an A, and a strategy that is just as good as they come. This strategy can absolutely change your life. It can make you a profitable trader. No guarantees, obviously. However, this strategy is my absolute favorite, and it's called stop fishing. All right, guys? Now, you might have heard of stop fishing before, but not in this way, because I'm going to break it all down for you. And I don't want you to trust me. Don't. What I want you is to test me, okay? So what I'm about to show you, I want you to go into the market yourself, go into the charts, and see for yourself that this works, that this strategy works day in, day out. You will get setups day in, day out. You will get setups all day long with this strategy, and I want you to test me, all right? So the first concept that you need to understand is who controls the market? Who's in control of the market? Is it retail traders, which is basically you and me, or is it big institutions? Well, guys, institutions can be anything from banks, hedge funds, it doesn't really matter. So JP Morgan, Goldman Sachs, it doesn't really matter. I can tell you now, these people here, they are in control, and they use us as liquidity. Now, what is liquidity? It's very important to understand what liquidity is, because without us, they couldn't make money. However, if you know when these guys place a trade, so if they go long, or when they go long, well, you also go long. And when they go short, well, you also go short. You can do that by understanding this simple concept now. So let's actually take a look. You work in a bank, okay? So you are a trader at Goldman Sachs, and your manager tells you, hey, I need 1,000 contracts bought at price X of the S&P 500 futures contract, of the Nasdaq, of oil. It doesn't really matter. And you see this chart as a trader, and you now have the goal of buying 1,000 contracts at price X. And let's say price X is right here. Now, what do? If you are a stupid trader, you wait for the market to go into your level, right? Boop, 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 boop. You are now at your level, and you click buy, and you buy 1,000 contracts in just one order. Well, what happens? The price shoots up. There's not enough supply that you can trade with to hold this market at this average price. Meaning, suddenly you buy 200 contracts here, 200 here, and all the other contracts somewhere up here. Meaning your average price isn't down here where you were supposed to buy the contracts for. Your average price is now somewhere here. So you have failed as a trader at a big institution, and you will get fired. You will get fired, all right? So what these traders do instead is they see the same chart, right? Exactly what we saw previously. And they now look at this chart and they say, what is retail doing? What are all these millions of people doing? They see an uptrend, right? So they place their stop loss right here, right? So people went long here, they bought, they bought, they bought, they bought, they bought. And because this now is a level of support, that's what they call it, we now have a level of support here, and all of these traders place their stop loss, which are sell orders. They bought in order to get out of the position they need to sell. So here we have a lot of sell orders. So this trader now has the same mission: 1,000 contracts at price X. Okay, price X is still here. And what this smart trader now does is he waits until the market goes somewhere here. He then sells, for example, and this is very easy now, he sells 200 contracts to push this market below this level of support. So he first sells 200 contracts right here. And because we have a lot of sell liquidity down here, he can buy up and get these people out of their position with ease. So at first, he buys back his 200 contracts, and now he starts buying his initial position. So he might buy 300 contracts here, then 200 here. He already has 500 contracts in the books. And then he buys another 200 here and another 300 here. So his average price is now right here. And then he doesn't get fired, but he gets, hopefully, promoted, right? And that is how the game works. Now, the cool thing is, once we see this happening, meaning a big institution starting to build up a position down here, first they manipulate the market, they bring the price below the level of support, then they start building up a large order down here, we can take a look at this and we can profit from this in both markets. For example, let's say we have an uptrend, right? So this is an uptrend. We can see that the market, for example, is trading up, 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 up. And then we have this. Guys, where do you believe the liquidity is right now? Well, obviously, right here. So all you have to do very soon, once we get to the next point, is wait for an entry signal at this level right here. Once the market comes back to this level, you wait for an entry signal right here, and then you go long. Same goes for a balanced day, for example. What is a balanced day? Well, it's nothing else than a market just going back and forth. So we don't see higher highs and higher lows. We just see highs here and lows here, pretty much at the same level. All right. Now, in this case, the cool thing is, with this strategy, you can actually go ahead and find entries up here, but also below here, where there's resistance and support. So where dumb money, also called retail, places their stop losses, right? So what do? Well, basically, you wait for a certain candlestick pattern to occur at this level, or this level, depending on what kind of market you obviously see. So this is a balanced day, obviously. So this right here is a normal candle. You've probably seen this candle if you've been looking at some charts recently, and then you know this is what most candles look like, right? Well, let's say this is a 5-minute candle, meaning this is a time-based candle. And this will become very important now, okay? Now, what this means is within these 5 minutes, this candle accepted every single price from up here to down here. Meaning it traded back and forth, back and forth, back and forth in between this candle. And within those 5 minutes, we had a pretty even distribution of where the market was trading in. But then on the other hand, you can see, you sometimes see candles like these, also a 5-minute candle. But this is what we call a hammer stick candle. Okay? And a hammer stick candle means basically that down here, where there's this long wick, the market rejected these prices. And guess what happened here? Well, let's combine it all together, right? For example, we see a balanced day. The market is trading in this beautiful, beautiful balanced day. And now a retail trader, an institution, has to go to, again, let's say he has to sell, he has to go short 1,000 contracts. So what does he do? He waits for the market to go somewhere here to this level. He then buys, let's say, 200 contracts. So the market pushes above this level of previous resistance. Once we are here, we have thousands of stop orders. So let's say we have, just to make the math very easy, 1,200 stop losses here, which are buy stops, okay? So in order for these people to get out of their position who went short here, they need to buy back the contracts that they shorted here. So we have buy liquidity right here. So what happens now is this institutional trader first sells 200 contracts. So he already made a very nice profit on this small trade, in and out. And he now starts shorting. So he starts selling 200 contracts up here, 300 here, and then it keeps on going until he has 1,000 contracts shorted at this average price. Now, this whole thing, this buying and selling, happens extremely fast, meaning the candle that you might see, this 5-minute candle, doesn't look like this. It doesn't look like a normal candle because this candle represents an evenly distributed trading 5-minute candle basically. What we do need to see for this to be our setup is we need to see a hammer stick candle. Obviously now the other way around, meaning we did not trade a whole lot of time above this level of previous resistance because this stop fishing, and that is what this is called, it just stops being fished above here. That is quick. The market goes up and the market goes down extremely quick. And that is how these candles are formed. And once you see this, you can basically go ahead and every time you see a chart like this, and we can make this a little bit more diverse for you. So I'm going to go ahead with an uptrend once more. We see this uptrend, and now the retail trader, the institutional trader knows down here there's all this liquidity. So he goes here, he starts with the first level of manipulation down here. He shoots the market below, and now you see a candle like this right here. What do you do, guys? What do? You obviously buy here, you position yourself with the institutional player. You set your stop loss below his level of the last order, and you either have a 1-to-1 risk to reward ratio or a 2-to-1 risk to reward ratio. So if your goal is to make $1,000 per day, and you, for example, have 5 prop trading accounts, which is not that difficult to achieve, you have to generate a whopping $200 per day in profit in order to get to $1,000 per day, obviously. Now, with this strategy, if you do everything correctly, you can, no guarantees obviously, achieve a 75% win rate. That means, and I did the math for you guys, you need to place 2 trades every single day per day with about $200 at risk in order to get to on average guys, $1,000 per day. So you take all of the inputs, the market that you trade, with the capital, which is in this case a prop trading firm, and the strategy, which in this case is the stop fishing strategy that we just walked through. And all of this can potentially lead to the good results, the good outcome of $1,000 per day in earnings. Guys, if you like this video and you want to have some further information on all of these 3 things, check out my channel, leave a like down below this video, subscribe to the channel, and I'll see you on the other side.